I've talked to a lot of investors over the years, and not one person has gotten mad at me when I told them I did better than I promised them I was going to do. Not one yet has complained about that. So I like to keep making those calls saying, hey, sorry, I was wrong. We did way better. I'm going to go ahead and keep trying to make those calls.
Welcome into the Get Invested podcast, a podcast about all things real estate and real estate investing, brought to you by Capital Velocity Investments and a part of the Matthias Talks Investing Substack. What's up, everybody? Welcome back to another episode of the Get Invested podcast with your hosts, Jordan and Matthias. We're excited to be here with you today, and we're excited that if you're watching and you're wondering, am I in a cell in a nondescript location?
That paint on those walls.
We are, I guess you could say, on location today. I am a couple doors down from Matthias in his office, and we're recording this podcast while I am in Florida. While Rachel and I are in Florida.
Hello.
Yeah, we're trying not to make sure to echo each other out of our minds. The ladies are currently, I think, out getting some pedicures. We're trying to squeeze this podcast in, and then then we're headed to, what can only be described as a death match, where it's probably going to be couples against couples bowling. So
yeah,
clearly,
I don't want to bring it up, but I kind of really do want to bring it up. That the title is being held in the Wilson household right now. We need to get a belt is what we need to do. We need to get a belt and just hand it back and forth.
Or like some ridiculous trophy like in the league or something. Just something.
Yes. For the record, last time Jordan and Rachel came down, they were talking bad game about, we've been bowling so much. We're like in the league. We're doing this, that, we're doing that. And Jen and I were like, we haven't been in months. And then we just waxed the floor with them. And this is true. It's kind of a claim to fame, and I'm happy that that's how it turned out, and I'm expecting it to continue today. But again, once we got to get a belt or something to play for, because it's just up in the ante on the bragging rights.
Yeah, I don't think we have anything on hand that could just be a stand-in, but we do need to do that. Now, I got to say, they say insanity is doing the same thing over and over again, expecting different results. Sure. So Rachel and I have changed our tactics. Last time we came down, we had been
You're going to bowl strikes?
Well, I mean in our preparation.
Oh, so you haven't been bowling?
Yeah, we haven't been bowling. So
same here.
Bowling a lot didn't do anything. So maybe not having bowled will do things.
You never know. You never know.
Yeah, you've talked that big game. You earned it. You guys, like you said, you got the trophy currently. But we may have to put an asterisk by this one because you're going to be rolling a kid's ball with that back of yours. So I don't even know if this is.
I'm an invalid, so I don't know. That's a good point. We'll see.
But
hopefully, maybe I'll get that little thing where if you set the ball on it and it rolls down for you, and I just like walk up and put it on there. Like with the very little kids.
Yeah.
You
just
put the thing on there. It rolled like literally the ramp.
Yeah.
With the bumpers and everything. Well, I shouldn't need the bumpers if I'm using the ramp.
That's true. Yeah. Now, I always appreciate when the ramp is has been somehow made into like an animal or some other fun thing for the kids.
Right.
So it's like if the ball comes out of like the animal's mouth or something like that.
I agree. The weird metal chair, but actually just a rail thing is not nearly as fun as the.
It's not really bringing it.
That is a ski slope.
Yeah. Now, Rachel was insisting we get photos because we haven't taken any while we've been down here. So you putting the ball on the ramp in your infirmity is definitely going to have to be one of them. So we'll get that one for posterity. All right. Well, we'll keep the rest of the trash talk, I suppose, for the lanes.
Yeah. Or until, we'll know how it went when you produce the rest of this episode. So you can add pictures of me obviously winning and Jen and I, just dominating and you crying probably. You can add those in post.
Yeah. Yeah. Okay.
Continue.
Sure. Yeah. I may cry, but we all know it's going to be the one manly tear slowly rolling down my chiseled cheek.
Okay.
Yeah. So that was too much alliteration for you. All right. Enough shenanigans. Okay, so that's the shenanigans, guys. It's all things real estate, investing, and shenanigans. Shenanigans out of the way. And now we're going to get serious, getting into the real estate investing. So today, what we're going to do is we know that we talk a lot about, we use the term conservative underwriting a lot because that's CVI's, philosophy, ethos, approach, whatever you want to call it. brand. So we thought today we would try to make that phrase very clear by showing you what it means to conservatively underwrite versus just underwrite, and what that really means in the process of assessing a deal. So Matthias is driving this ship because I'm not at my command center in where I got 4 screens, but so he's gonna walk us through that process of a few key metrics, is my understanding. Now, I'm actually standing in for the listener because I haven't seen any of these numbers. I haven't heard any of what he's going to say. So he's got to explain it to me just like he's got to explain it to you. So we're in this together, listener.
Yeah. Okay. So I'll start off by saying every time I get a deal comes across my desk, I'm going to do a quick high level, does this make sense? Do these broad general numbers make sense? Is this a deal? Is this a super expensive deal per unit or whatever? And what should it be getting to this market? What is it getting to this market? I'll have a general idea of whether it's even worth like plugging and playing on we have a lot of spreadsheets here. So as you can imagine, when we're calculating what the projected returns are, what the risks are, how vulnerable we are to all the different things that could happen, and how I'm like we're talking about today, how I can make it conservative, you're gonna have to use spreadsheets. So that's what we're gonna do today. I've got one made up with a completely made up scenario. Matter of fact, I would buy this deal if it was here. The way I built it seems pretty awesome. I kind of want to go, but I'm just saying, like I put it together to illustrate what I can manipulate, how I manipulate it, why I manipulate it, in broad terms. I'm not going to get too far into the weeds, but what I'm looking at when we're considering a deal, and if it makes sense to pull the trigger and bring on investors and go after it. What I'm going to do is I'm going to share my screen here. We're going to pull up the spreadsheet. Okay, so obviously this is going to be spreadsheet heavy, but what I'm going to try to do is talk for those of you who are listening and not just watching. I'm going to try to explain what I'm clicking, what I'm seeing, what I'm reading, what I'm manipulating as we go, so that you can understand as well. So if I fail at that, then send us some hate mail or something. Okay, so we're going to start off this make-believe scenario that we're going to underwrite. Quote unquote underwrite here is going to be a 50-unit deal in, doesn't matter the market, and the asking price. Let's say the asking price is $5 million. So as you can see on my screen over here, we've got the purchase price in our spreadsheet built in, because it calculates based on purchase price, amount of capital we have to raise, all these different things that we look at when we're considering a deal. So I'm just going to really briefly go through some of the things some of the inputs here. So 50 units, if it's $5 million, that's $100,000 a unit. Looks at a 30% down payment means we have to bring 1.5 million. Sorry, loan balance is going to be 3.5. Repairs and reserves, closing costs, etc. on there. So nothing huge there. Obviously, I guess I should start off saying that something that can impact your returns when you're talking about buying a property is a down payment percentage. So a lot of times, like back in the day when interest rates are super low and banks were trying to lend to everybody, you could get like a 75% loan to value, or even an 80% loan to value, an 80-20. So you would only have to bring a 20% down payment. We don't live in that world anymore. So 30% is about as good as you're going to get, unless it's some sort of high leverage bridge, something or other loan. So that's something that can make or break a deal. Frankly, one of the big things that we look at is what kind of debt are we going to be able to get on this property. Agency debt is like typically going to be your lowest rate, your lowest interest rate, but you may have to bring a little bit more capital to get the locked in. It's going to be the longest term, so it's going to be a safe, low rate, safe, but it's also going to be, you're going to be bringing more cash than if you just went to a bank. These are some of the things that we can manipulate. So, like if I change this to a 40% down, let's say they only give you 60-40. That can change the entire, and I'll show you a little bit on our return calculations, but that can seriously change the complexion of a deal, whether it makes sense or not. So we'll leave it at 30% for now, but that's just one of the things. So here it automatically, I put in this gross potential income of $650,000 for a property like this. Pretty, that would make sense. We would look at that. We would see that average monthly rent. So let's say $1,083 per unit of those 50 units. and we plugged in a vacancy rate of 7%. The markets we look at are going to be less than 7%, but we typically underwrite to a 7% as one of those safety factors that we put in. Like typically we're going to be in a 5 to 6% vacancy rate, but we'll bump it up to pad the numbers on the cautious side.
So if I'm hearing you correctly, this is a very specific instance of conservative underwriting in that there's the market, the research, everything says vacancy is going to be around 5% on average over the life of the investment, 4%, somewhere around there. But you're going to see if it works at a higher rate of vacancy, just to say if things go wrong.
Yes. And in another, like if we're doing a real heavy value add where we're going to be, it's going to take a while between, like if at lease renewal, we're going to say, hey, tenant, we're going to renovate your unit. So please move out or move into a unit we've already renovated, something like that, where it's going to take some time. We'll bump those vacancy numbers up because it's going to, if we're going to make, let's say a month and a half to renovate a unit in between tenants, we're going to bump that vacancy rate up because we're going to induce some vacancy on there. So all this to say is that we're always going to assume more vacancy than we actually think is going to happen. And that's one of the ways that we conservatively underwrite because we're backing off our numbers of our potential income. I mean, I'm comfortable when I know I'm going to beat my underwriting. You know what I mean? If my underwriting goes and we talk about this all the time. So like if I underwrite and I say 7% vacancy and we're doing a light turn, so there's no heavy value add, which is when we would use this 7%, I'm confident that I'm going to beat that. And I'm comfortable taking that to an investor going, if something happens that I can't put these tenants in units or turn these units as quickly as I think I can, and I've backed it off the numbers. That's just one of the ways that we're confident in our projections because we've backed off that way. Getting back to this.
Well, I did want to ask one thing.
Go ahead.
Real quick before you move on. Now, do you generate the gross potential income from a target rent input, or is the average monthly rent driven by an estimate of what the gross potential income will be?
Great question. When I put it in this particular part of the spreadsheet, I'm taking this from what has been passed to me from the seller. Right. This is what we did over the past 12 months, 650,000. So this is separate. And I'm about to show you what I change it to when I think I'm going to be able to improve the rents on. Let's say these are 3-bedroom, 2 baths, and I'm going to be able to rent for, it doesn't matter what they are, but let's say I'm going to be able to rent them for $1,500 per unit. So after the value add, whatever it is, I have a super light. I have 150,000 for 50 units. So like, let's say I'm putting really nice backsplash in each unit, and that's going to give me huge rental increases. Or maybe there's a bad management play or whatever. So in this scenario, I've made up that I'm going to be able to I'm going to get these rents up to $1,500 per unit, and I'm going to show you how I do that. So when I'm starting, the year one stuff is always based on actuals. It's based on what the real expense is, or even a padded version of the real expenses. If I'm looking at, I know my market. So if I'm like, hey, it costs X amount to do of upkeep per unit in this market for these age of units, and I see a seller is like, hey, here's my financials that show only a little bit of XYZ expense, I'm going to go with my numbers, what I know it costs to run in that market. And that's another way I'm going to say, hey man, you had a light year, but I know what it costs generally to do this type of unit in this type of market. And I'm going to run my numbers based on that because he may have had a light year where he didn't have to replace any HVACs or, whatever it might be. I'm still going to go with what I know it costs to run properties in a market. So what I'm going to go to now is I'm going to go over to the profit and loss calculator. This is the bread and butter of this spreadsheet. What I manipulate in here is how I make the returns. So what I'm going to show you is kind of the year one. Like I said, we go on actual. So we've got the same income, the same vacancy, and then I just plugged in some numbers that made sense on the expenses here. So the taxes, the insurance, those are always the two biggest offenders in terms of expenses. Taxes and insurance are the big ones. And then on down the list here. Management fee is manipulatable based on what your property manager is going to charge, and that depends based on income. So that's a variable cost. Like the higher rent you charge, the higher that cost goes up. So anyway, what I'm going to do is I want to draw your attention to this line right here, the average monthly rent. So as you see, that's the same one from the front page, is $1,083. I'm thinking I can get to $1,500. I'm going to one of the best ways I can be conservative is how long I think it's going to take me to get rents up. Now, if I'm doing a light renovation and just a management play, more likely I'm going to be able to get rents up towards the end of year 2. As renewals come due, I'll offer deals and concessions to get people up to the market rate rents, and by the end of year 2, we'll be there. If there's renovations that have to take place, then it'll take more time, right? Because we were talking about earlier the vacancy rate and all that, and it depends on the reputation of the property. All right, if it's known as it's not the best, nicest place, it may take more time to rebrand and kind of prove to the local community that, hey, these are the units that you actually want to be in now, and that kind of thing. So this is one of the biggest ways that we add the value and how I calculate adding the value, if that makes sense.
Absolutely. And I think everyone understands that the target is based on the market, and then the increments are basically just kind of like common sense. There's going to be increments between what it is and the target. It's not, that's not some fancy calculation.
I can't just take over in day 2,
Yeah. And jack up rent. So it's like anybody who's rented knows the incremental rent increase.
Sure. Well, and something to note here is that this is one of the ways that I'm very conservative over what I could do, because I think it's going to take, in this scenario, I think it's going to take 2 years to get the rents up there. But it's going to take 2 years using what's going on today, right now, here in this market. And this is, case in point, some past investments we bought right before COVID. Turns out you're not always guaranteed this environment that you live in right now is going to continue for the next 2 years to do your business plan. So I like to introduce a whole lot of extra time that it might take me to accomplish this business plan exactly the way it did. It played out back, if we got hit by a hurricane on this property, or if Black Swan, COVID event happened, something like that. I just want to make sure that even if I can't hit my timeline, so I pad this out. It takes me, per the spreadsheet here, I have it taking 4 years to get all the way to my $1,500 number, which I'm confident that I could, if I had these perfect units today, all derivated, I could go rent them for $1,500. I'm putting into my spreadsheet that it's going to take me 4 years to get there, because I want to guard against these downturns, economy crashes, whatever it might be. I want to guard against that, and I've been proven right. So there's no way I'll change this underwriting strategy just because we do not know the future. And I cannot guarantee that the environment I live in now is going to persist for however long it takes me to execute my business plan. So I'm going to pad it.
Yeah. And one last question on this. When you project out further, do you also at that time, calculate your rent number factoring in inflation? You had a number, but you're like, okay, if it takes 4 years, then I need to go up a little bit more, because over time there's going to need to be increase just to keep up with inflation.
Great question. So if this top number here, I can manipulate the annual rent escalator by 3%. I can have 1%, 0%, 5%, whatever I want, and same with expenses. One of my typical moves is I'll go 3% on the annual rent escalator, and realistically, any market that I invest in is going to beat that. This is just another way that I'm hedging, that I'm conservatively underwriting. But in this scenario, that's exactly another way that I'm making it conservative. Is I go, if everything stops and freezes and there's not another dollar to be made in the rental market, I'm going to do $1,500 in year 4. Realistically, there's going to be whatever the rent increases for a market. It's going to happen during the time that I'm executing this business plan. But basically what I'm doing is I'm underwriting to if the market is slightly worse than it is today, because in terms of actual inflation, just like you said, realistically, it's like if it's 1,500 in year one, it'll probably be close to 1,600 by the time I get my units up to the 1,500 number. But in the spreadsheet, I'm going to go, I believe it'll probably be 1,600 by year 4. I'm keeping it in case the market is slightly worse. It takes me 4 years to get all the way to where it is today, but it's cooler market now. That's the conservative underwriting that I do.
Okay. All right.
Yeah. So what now I kind of want to transition to a little bit. These are just ways that I, on the business plan, executing the business plan, the ways that I try to make them conservative. I'll show you what the impacts of some of these variables are on the actual returns that we're projecting and we present to investors when we say, hey guys, you should invest in this deal because here's what we're looking. So this is kind of the summary of the spreadsheet investment. So all these things are put in here. Here's one of the biggest ones right here. Cap rate at resale, meaning what are investors in a market going to pay at the time we sell? Typically, this is a 5-year business plan, so it takes us 4 years to get the rents up to market. We've done our renovations, and then we're going to sell in year 5. That's the business plan that I've put into the spreadsheet. But one of the biggest ways you can trick the numbers here in the spreadsheet into giving you amazing numbers is by manipulating the cap rate at resale. Meaning, maybe I think investors are going to pay a lot more for the same type of investment in 5 years when I'm done with this. And that means it's going to give me a great return. And that's an assumption you can make, but it's not a conservative. I never underwrite thinking that the market is going to be better than it is today, if that makes sense. Yeah. One of the ways we underwrite is that, hey, let's say investors are a little bit more hesitant than they are today as I'm talking to you, or as I'm underwriting this deal, buying this deal. I'm assuming things are going to be just a little bit worse. So this number here, I'm going to show you how easy it is to manipulate. So this amazing opportunity gives us a 19% IRR, an average annual return of 25, almost 26%, right? But that's at a 6% cap rate at resale, which is I don't even remember. Hold on, what is our cap rate right now? It's about 6%. Okay, so it's exactly the same as it is in this opportunity. So I'm assuming it's about the same. Here we go, and I go, okay, it's a great return. I'm going to go ahead and buy it. Or what happens if it gets a little bit worse? So 6.5%. Now those numbers drop off significantly. It goes 19 to below 17% IRR, because if that market this is kind of a sensitivity test that we do with our investments. Say, hey, what happens if interest rates go up again, and which means that investors are not able to pay as much per dollar of income, which is how we're valued, and that gives us that dampens our returns. So this is one of the easiest ways for me to make stuff up and say, hey, maybe the world will be a little bit better place when we sell. And if I'm assuming that, it's easy for me to project great numbers. But if it's not a reality, or if I'm assuming it's going to be better than it is today, it may be better than it is today. I don't know that, and I'm never going to underwrite to that. That's a way that we're padding our numbers on the conservative side, because I'm always going to assume that it's slightly worse than it is. So in this scenario, 6.5% is probably a good number to say, hey, we're buying at a 6, the market is 6. We're just assuming in this case. I would underwrite to a 6.5 just in case things got a little bit worse. Does that make sense?
Right. Yeah. So again, for all those out there that have actually listened from somewhere near the beginning, you'll remember that the cap rate has been a saga. Beginning of the podcast, right? Cap rate has been a thing that continues to recur. So the higher the number, that means the lower the property will sell for,
right?
Because they're not willing to pay as much for the income they're buying.
Exactly.
As in other situations.
Think of it like investors in a market with a high cap rate are demanding more dollars of income per dollar spent on purchase. They're like, you got to pay me more to be able to buy this property. This property has to pay me more in order for me to want to buy it. That's
the mantra of
the cap rate.
Yeah, the mantra of a cap rate is like the opposite of stocks. It's buy high, sell low.
Exactly. If you can buy it at an 8% cap rate and sell at a 6% cap rate, you've just made a lot of money. A lot of money. So, so I mean, these are at the risk of being too in depth and nerdy on this. I'm wanting to point out this is how we when I every day I look at a deal. Whenever a broker or somebody or a friend or somebody sends me a deal to look at and evaluate, this is what I'm doing. When I'm confident it might be a good deal, I'll go ahead and plug in all the numbers, and then that's when I really get to work, because I'll go, okay, what happens if interest rates go up? And I can manipulate the loan, the assumed loan that we're going to get. And I don't need to get too far into it, but these are all the different. I can change the expense ratios. I can change how long it takes me to get to where I think the market rents are. These are all the ways that I can manipulate this spreadsheet, but manipulate the variables to say, hey, how susceptible are we to this and this particular investment or that? And this is the thought process that I bring in whenever I'm going, hey, is this something I want to take to investors or something I want to get under contract and go after or not? And the fact of the matter is, it has to beat our projected metrics. The ones that we kind of our bottom line. It has to do this cash on cash and this IRR, et cetera. But it has to beat those, and it has to beat those after surviving some of the stress tests and some of the mean stuff I do to it in the spreadsheet here, in terms of, hey, I don't think, if I know what I think I can do, but even if I can't, if it still meets all the metrics, that's when we really pull the trigger.
Yeah. And so, I mean, it's kind of interesting that there's a way in which there's a lot of leeway, right? Like we're not going to go after a deal where there isn't, right? Some, because otherwise you're putting yourself in a tight position. It has to go a certain way for it to make sense. But at the same time, there's also a way in which, like, one number changing drastically could just make the whole thing not worth it. I mean, not that this is anything that we've experienced recently, but for instance, if you go back and you put the insurance as, like, I don't know, 80% more than that, all of a sudden, and you would think, oh, well, in a project this big, millions of dollars, you're buying at this, there's rents, there's 50 units. How could, 50,000 every year make that much of a difference? And it's not that it would all of a sudden be losing money or not making any money. It's just, is it making enough money to make it worth everything else that goes 100%. Into it?
Perfect example. So let's say in this scenario, what I've plugged in here is that, okay, the real estate taxes are $85,000 a year on this mythical property, and the insurance is $105,000. So it's about $2,000 a unit. So it's probably a coastal property. Let me tell you that. I have experience in
exactly.
For it to be $2,000 a unit per year. But let's say it's this one number goes up to, we'll call it 140 instead of 105. It's $140,000 a year. Look what, like, okay, that's a huge increase per year. It changes our net operating income down here to a lower number. It was at 300,000. Now it's at 267,000. And then I'm going to take you back to the metrics page, and it's going to show you how bad it actually got. Okay, now our IRR is down to 13%, and our average annual return is down to 16%. So, and cost, not knowing a cost or a cost increases can just, again, we're going to be, I'll go back to we're still positive. We're generating positive income, but it's not the positive income that we projected. And therefore that hurts our overall numbers, because yes, we could operate this property and it would be at an IRR, but if it doesn't meet our metrics of what we want to get, then it's not worth me taking investors' cash and putting it into a thing. I'm gonna make sure that it's gonna meet what is our minimum criteria in order to deploy my capital just as well as the investor capital.
Yeah, because I mean, if you won't go back to I think it's the P&L sheet, one of the things, I know we don't want to do too much of a deep dive, but if you started going, okay, what does that mean for, like, catching up on preferred returns, and what does that mean for how much people are actually getting back, and one of the things it's definitely going to do is slow down money returning, right?
Yes.
So
yeah, because it's a simple math question at that point, because it's okay. I was thinking the property was going to earn $300,000 before debt service of income on the property, but if it's only going to make 260, that's a significant. What is that, like 15% change, whatever it is?
Yeah, because on this loan at 5%, which would be an amazing percentage right now, it's the total debt service is exactly. It's great bank.
They're back.
Yeah. I mean, look at that debt service. Even at 5%, that's 225,000. And so that difference between 300 to 260, that's huge. Even though it seems like over the course of all numbers that wouldn't be that much, but it is.
Yeah. So, I mean, the baseline of talking investing is what is going to be the best investment for my money, and you have to have a baseline of returns. Like, hey, if it's not projecting to break 15% IRR or whatever, then you also got to look at what the market is giving you. So, like, if I have an opportunity at something Matthias isn't offering, a different guy who's offering a 16% IRR in all, he's conservative underwriting, he's doing all these things. Or Matthias, let's say Matthias has two investment opportunities going. One of them has a 14% IRR, one of them has 17% IRR, both underwritten the same way, similar markets. You trust Matthias in these markets, all that being equal, you're going to go with the higher IRR because it's like, hey, I want to build wealth quicker. I want the more money back faster. That's your prerogative as the investor to demand that from somebody who's asking for your cash. And so that's exactly what goes into my mind when I'm underwriting these things. Is I go, and frankly, I'm an investor, so I want to invest my money in the best way possible, and I want to bring all my friends to do it when I find a really good one. And to me, the criteria for finding a really good one has to meet certain metrics, I guess, is what I'm trying to say.
Yeah, and well, I mean, I think you're saying it well. Just different ways to think about it, because I think people who understand numbers but don't necessarily understand, like making the calculated risk of an investment, or not they don't understand. It's just not something that they're practiced at. Let's put it that way.
Yeah. Not familiar with. It's not a common thing, because nobody, only I am really, because this is what I do. But most people do other things with their lives.
Yeah. I mean, at that point, it's like all other things being equal, and understanding that capital to deploy is finite. Like, if there was infinite capital to deploy, sure, it's fine.
You just make every investment ever.
Yeah, exactly. But you have to pick and choose, and we don't live forever. Although some people apparently are trying. Supplement man, but like you
Not
have
me,
to.
I'm falling apart.
You have to time. The finiteness of both time and money puts that pressure.
Requires you to be choosy.
Yeah. And that's because I think a reasonable person who wasn't familiar with the stock price would be like, well, you're still making 15%, but it's not a matter of that being terrible. It's is that the best way to use the money?
And I'll take that a step further. So let's say I have a 15% IRR deal. Again, all else being equal, we trust the operator, we trust the market, we trust the analysis, we think it's conservative. All else being equal, if you get a 15% IRR deal today, but the market is commonly bringing 16, 17, 18% IRR deals to you, maybe you wait 2 months until you get to the, you know what I mean? Like, you're just, hey, this one might be an okay deal, but I know that I've been seeing good deals, great deals lately. You know what I mean? So conversely, in a bad market where there's not a lot to buy, you go, hey, I'll take a deal as long as it scrapes by and I'm confident there's a good margin that I'm protected from a loss. Maybe I just got to get some money to work. That's also something you got to think about. The opportunity cost is something that we're always considering here.
Yeah.
Is this something you're going to wish you had been on, or is this going to be something you're glad you glad you waited until you found something better? That's what I'm trying to make that answer to everybody be, I need to be in on this one because it meets all the metrics. And I know you've poked it to death with, things going worse than you think it's going to go. That's kind of my goal. And it's hard to find deals like that a lot of the times. Sometimes there's not all going to be home runs, right? Like sometimes they're just going to be like solid deals. Okay, that are good, that I've poked a little bit and it's like, okay, I'm confident that we're not going to lose money on this. I'm confident we're going to make money on this. May not be a home run. We may not be dancing in the streets when we sell this thing, but I'm still going to bring those opportunities if they've passed all my criteria and they're high enough of a return.
Right.
That I'll bring them to people.
Right. Gotcha. Well, okay. I honestly, I don't have any like smooth way to wrap this up. Those are the numbers. I don't know.
And that's the way the cookie crumbles.
Yeah. And that's the way it is. But I think it is it's good because I'm speaking for personal experience going into the spreadsheet and just kind of changing the numbers myself and just seeing what happens and knowing how those things are calculated and people knowing what it just means. It really just means you have I guess, intellectual fortitude to like push back against the very natural human inclination of like being optimistic.
Yeah. Yeah. I'm a pessimistic investor. That's a good way to put it. Yeah. Because what I want to do is I want to protect myself from things going wrong. So if an investment requires me to get everything done in 2 years to be able to make the same returns, I don't want it because I want to have some padding. It's like, hey, what if it takes me 4 years? Am I still going to make the same returns? Because all that does is I send projections out to people, and then if things go right, if things go normal, I'm going to crush those projections and I'm going to do a lot better. Which I've talked to a lot of investors over the years, and not one person has gotten mad at me when I told them I did better than I promised them I was going to do. Not one yet has complained about that. So I like to keep making those calls saying, hey, sorry, I was wrong. We did way better. I'm going to go ahead and keep trying to make those calls. And if we don't, it's an opportunity cost. It's not I didn't lose them money. I said, we could have made some money on that one, but it was a little bit risky and it couldn't withstand this, that, and the other thing going potentially wrong with it. So we didn't pull the trigger and we did not invest any money on this one. Nobody's going to call me back and say, hey, Matthias, I'm really mad you didn't pull my money and invest in that thing. What they are going to do is if there's a chance that I could lose money or that they're not even coming close to the returns we think we can get because of variables going wrong, I don't want to live in that world. I want to live in the world where I rarely pull the trigger, but when I do, I'm confident. That's the world I'm going to live in.
Absolutely. All right. Well, I think we're going to wrap it up there because we have a date with our wives.
A date with destiny.
Exactly, with destiny and bowling. So we're going to wrap it up there. Hopefully that was helpful, guys, to understand what we mean when we throw these terms around. If you got any questions, of course, you can reach out the many ways that are possible, commenting on this on Substack or on Spotify. You can comment there too, sending us a note, DMing us on LinkedIn, email, all of the things. We're easy to get a hold of. So please reach out if you got any questions.
I will say that anybody wanting to, like, if this makes you extra curious and you want to kind of dig into my spreadsheets a little bit, feel free to jump on a call with me and we'll go through, if you're one of our investors, we'll go through any deal that I'm looking at, any deal that we've done, and we'll dig into real numbers on real deals and thoughts, and I'll explain all the assumptions that I make. There's a lot, but I'm happy to go through with all this. This is what I do. I love talking about it, and I can talk till Jordan's ears fall off if I need to, but that's open for anybody who wants to learn more.
Yeah, just an added benefit of being a part of the investor pool. So if you're not, as I've said before, the amount of time you've just listened to this, you could be in the investor pool. So please take advantage of that and all the ways in which that will just empower you with, just more information about what's going on with us, and also just what a good investment looks like, even if it's not with us. I mean, we prefer that, but we're here also to educate, and that is a benevolent, mission. So come learn with us, and just come learn with us. There was nothing else after that. Just come learn with us. Okay. All right. Well, we're going to really get out of here this time. We really appreciate you listening, and we hope you come back next week for another edition of the Get Invested podcast.
See ya.
I can see clear